The top business stories live from the Sky News City studio. The UK economy contracts in May, but by less than expected. Profiting from a changing world, the CEO of Wood Group on how it's leading the transition to green energy. And high-end expectations. Retailer Watches of Switzerland defies the gloom with record results. Good morning, this is Business Live with Ian King. The UK economy shrank by less than expected in May. It emerged this morning. UK GDP was always expected to contract during the month due to the extra bank holiday for the King's coronation. But a contraction of 0.1% was better than the 0.3% that had been anticipated. The Office for National Statistics said all parts of the economy contracted during the month, with the exception of the services sector, which merely stagnated. The ONS said there had been benefits to businesses in the arts, entertainment and recreation sectors as a result of the coronation, but warned manufacturing output had taken a hit from the extra bank holiday. The UK economy is now estimated to be 0.2% bigger than it was in February 2020, going into the pandemic. Separately, the government's fiscal watchdog has this morning warned that the UK's debt is at risk of rising to 3 times the country's GDP by the 2070s. The Office for Budget Responsibility said the 2020s were turning out to be a very risky era for the public finances, warning that as the baby boomer cohort retires and pushes up the cost of the triple lock, state pension spending is expected to be £23 billion higher in 2027-28 than at the start of the decade. It also warned that rising take-up of electric vehicles is expected to cost £13 billion a year in foregone fuel duty by 2030. Now, while many parts of the economy face headwinds, there are plenty of businesses enjoying robust demand. One such is John Wood Group, the global consulting and engineering business. The company, which employs more than 35,000 people around the world, including 4,500 in Aberdeen, this morning reported sales of $2.9 billion for the first 6 months of the year, up 15% on the same period in 2022. Well, joining me now is Ken Gilmartin, the Wood Group CEO. Ken, very good to see you this morning. I mean, you're enjoying growth in all parts of the business, but particularly in project work. What's behind that?
Yeah, Ian, listen, thanks for having me as well. Delighted to be on. You know, what we're seeing in our projects group growth is consistent across the entire globe. So our end markets, energy security, energy transition, chemicals, life sciences, as well as mineral processing. What we're seeing is clients investing money. We're seeing clients investing money across all of the geographies that we serve. And I think, you know, for us as Wood, we're in those right markets. We're there the right way and we're there at the right time.
Obviously, viewers with longer memories will remember you primarily as an oil field services business, but you've clearly diversified over the years. How long before oil field services is the sort of smaller part of what you do?
Yeah, I mean, I think oil field services is part of that energy security that's, you know, fundamental and a foundational piece of where we are as a group. You know, we've embarked on a 3-year strategic cycle, Ian. And as we move through that strategic cycle, energy security, energy transition are still going to be big parts of that. But as we go through that 3 years, energy transition is going to become more important. And then you look into the materials business that we have. So we have mineral processing, we've got life sciences, and as I said, originally we've got chemicals as well. And as we go through those years, they're going to continue to grow as well. So our portfolio is diversified, but it's underpinned by the 36,000 people that we have that are the world-class subject matter experts that we're really proud of.
Now, the Biden administration is incentivising investment in green energy to the tune of $369 billion. Is that changing the way you're deploying capital around the world?
I mean, I think it's been absolutely an accelerator. And I think it's definitely in that energy transition space where, you know, we have got leading subject matter expertise. That has become that accelerator for growth as well. And, you know, we've got over 10,000 people in North America, and a lot of those are really, really excited about that opportunity that brings, because it does facilitate that acceleration that we have. Where we're really good is where we can join the dots from a global standpoint. And that means bringing the best, the brightest resources, the subject matter expertise that we have anywhere in the globe to bear, irrespective of where the capital is being deployed. And that's what we're good at. That's our differentiator, and that's what we're going to continue to do.
Closer to home, there's obviously been a lot of unhappiness in the UK oil and gas industry about windfall taxes. Has the UK government done the right thing, in your view, in reining those in?
I mean, I think, look, tax policy is probably something to have a conversation with the politicians. I think for me and where we're looking at is you got to make sure, however, that there is an absolute focus on investment. You know, the UK needs critical infrastructure. The UK needs to continue to invest. And as that journey to net zero continues to go, that energy transition is going to take pace, and you need to continue to invest in order to do that. So that would be my piece on windfall tax, yes or no, but make sure that we're continuing to invest where we need to.
Now, your headcount rose during the first half. You're taking on more people. Is the skill set that you're looking for different from how it used to be?
I think it's continued to evolve over the years. I think we're still very heavily dominated by engineers, scientists. What we're seeing more is data analytics starting to become more prevalent in the stuff that we're doing, particularly as we're on that journey to AI and some generative AI in the design of what we're doing. So yeah, skill set continues to evolve, but that ability to have people that critically think and can solve what are the world's most critical challenges that we're facing at the moment is still something that we're always passionate about, and making sure that we get the brightest and the best.
And I mean, I've got to ask you this, Ken. Obviously, during the first half of the year, you had no fewer than 5 takeover approaches from Apollo. How much of a distraction was that on management time?
Yeah, I mean, I think at the top levels of the organization, certainly it was a distraction. But I think the important thing for us as a company was we embarked on a new strategy in November last year, Ian. And I think irrespective of the ownership, we knew that the strategy that you have is a strategy that we're going to execute, that we're going to grow, we're going to win. And I think the results that we showed today showed that the strategy is continuing to work, that we are in those right markets in the right way at the right time. So I think the distraction, yes, for management, but for the 36,000 people that we have in the organization, we've built significant momentum in the first half, and that's by being able to stay focused on the strategy that we've unveiled.
Ken, got to leave it there. Terrific to talk to you this morning. Thanks very much indeed for joining me.
Yeah, thank you, Ian. Take care.
Bit of breaking news that we can bring you. The BBC Director General, Tim Davie, is to be questioned in Parliament following the Hugh Edwards scandal. The BBC Director General, the acting chairwoman, Dame Elaine Closs-Stevens, and the Policy Director of the BBC, Claire Sumner, have been called to appear before the House of Lords Communications Committee next week. Now, amid all the talk about the need for the UK to build gigafactories to service the electric vehicle sector, it's worth remembering there are alternatives to lithium-ion batteries, chiefly solid-state batteries. Well, specialising in the latter is Ilika Technologies, a spin-off of the University of Southampton's chemistry department. Today, it reported turnover of £702,000 for the year to the end of April, up 42% on the previous year, but its pre-tax losses widened by 11% to £8.9 million as it ramped up spending. Well, joining me now is Graham Purdy. He's Chief Executive of Ilika. Graham, good to see you this morning. First of all, very simple question. For those who aren't in the know about these things, what's the chief difference between lithium-ion batteries and solid-state batteries?
Morning, Ian. Many thanks for the invitation to join you this morning. So the principal difference is that in a solid-state battery, the liquid electrolyte and polymer separator, which are put between the two electrodes in the cell, are replaced by a lithium-ion conducting but electrically insulating ceramic, which allows the battery to charge and discharge and gives it a very compact design. And
what are the advantages of solid state as you see them?
Principal advantages are that you get a higher energy density of the cell. And what that means actually is that when you put these cells together to form a battery pack, it gives the consumer a longer driving range for the vehicle. So it overcomes some of that range anxiety. Second advantage is that normal lithium-ion batteries are flammable. And when you replace that liquid electrolyte with a ceramic, you turn the battery into a much safer device. And therefore, the amount of engineering that you need to put into the battery pack once it's in the vehicle is reduced. And therefore, the cost and bulk of the battery pack is minimized.
Well, we might get on to EVs in a moment, but it means probably the big landmark for you during the first half was the M50, which is your smallest solid-state battery. You've started delivering those, I gather.
That's right. We've got two product lines. On the one hand, we've got our Stereax batteries, which are miniature batteries designed specially for miniature medical implants. And we've started delivering them from our UK facility. And then on the other hand, we've got our large format Goliath cells, which are designed for EVs. So the technical maturity of our Stereax cells has increased to the point where we've been able to start shipments to customers.
I gather the Stereax is less than a millimetre thick. I mean, that's absolutely extraordinary.
Yeah, we've designed these cells to be the minimum size possible. You can imagine if you're unlucky enough to need a miniature medical implant, then actually you want cells that are absolutely thin and tiny and need the minimum surgical intervention, as well as being intrinsically safe. There's no toxic liquid electrolytes that can leak out of these Stereax cells. And that combined with their long life means that the implants are in demand.
And where are these being manufactured, Graham?
So at the moment, they're being manufactured at our facility here in the UK, just outside of Southampton. We have a small facility that we built over the last couple of years. We've just entered into a scale-up tech transfer deal with Certec, which is a large US headquartered company that specializes in medical devices. We're at MOU stage with them, so Memorandum of Understanding, and we're finalizing the contract to the point where we can carry out that tech transfer in the second half of the year with a view to ramping production and selling to what are primarily US-centered OEMs into their medical devices.
Graham, I wanted to ask you about the Goliath, but I'm afraid we're out of time, so we'll have to do that another day, I'm afraid. Thanks for joining me today.
All right, thank you.
Well, the pound has continued to grind higher against the US dollar on the foreign exchange markets following yesterday's benign US inflation data. Sterling this morning hit its highest level against the greenback since the 21st of April last year. It's currently ahead by 0.5%, touching $1.31. The oil price is also ticking up on the back of the weaker dollar. A barrel of Brent crude will currently set you back $80.33 a barrel. That's up nearly a third of 1%. That's an 11-week high that Brent crude is currently trading at. On the equity markets, Wall Street's gains last night were followed by a solid session overnight in the Asia-Pacific region, during which the Nikkei in Tokyo enjoyed its best gain in a fortnight. In Europe, stocks are also in positive territory right now, again lifted by hopes the Federal Reserve may soon be done with raising US interest rates. Talking points this morning include the Swiss watchmaker Swatch. Its shares ahead by 6.5% in Zurich on better-than-expected results. Well, here in London, the FTSE 100 is also in positive territory, up a third of 1% right now. The mining heavyweights are lending support there. Among the fallers, well, the leading FTSE faller is the house builder Barratt Developments. Rather downbeat trading statement it put out this morning. The shares off 3.25%. All of the other major blue chip house builders, Taylor Wimpey, Persimmon and Barclay Group, are down with that in sympathy, as you can see there. Outside the FTSE, Currys is ahead by 1.5%. That's on news that the Spanish investor Cobas Asset Management has raised its stake from 8 to 9%. Meanwhile, International Distribution Services is at another 1.5%, and that is after its Royal Mail arm yesterday reached an agreement with the unions. Well, joining me now is the head of equity research at Rathbone Investment Management, Sanjeev Tumkar. Sanjeev, great to see you. I haven't seen you on the programme for a while. This statement from Barratt Developments is a bit downbeat, isn't it?
Yeah, it's tough times for the house builders at the moment. We've seen what's happened with mortgage rates. Obviously, the consumer's under pressure. It's not a great time for sort of affordability. But having said that, I think if you step back, the house builders have learnt the lessons from the previous down cycles. They've got strong balance sheets. Barratt's has reported a net cash position of more than £1 billion. So I think that should give people confidence that whatever the vagaries of the near-term trading, that the company's well placed for the long term, and it actually got the balance sheet to take advantage of opportunities if they see land prices fall.
Of course, they said today that they're going to build a fifth fewer houses this year than they did in the last financial year. That has a knock-on effect to brick makers. I mean, I see Forterra and Ibstock, the two quoted brick makers, have been in the doldrums lately, and likewise some of the builders merchants, presumably.
Yes, absolutely. It's that whole ecosystem beyond just the house builders, that multiplier effect. But equally, when things do turn a corner, and I'm sure they will before too long, then you get that positive multiplier. But clearly, you know, with interest rates where they are now, that's having an impact on the real economy, and the house builders' 100% domestic UK earnings is one of the areas that's going to face that.
Yeah. Now, another stock that caught your eye, again, in the FTSE 100, Experian. We don't talk about that on this programme very much. What did you make of what they had to say today?
I think Experian's a really, really interesting UK global leader. We have a number of them. I think sometimes people are quite downbeat on the UK economy. We've actually got a lot of really good companies. Experian, you know, a global leader in data services. It started from quite humble origins in credit bureaus, and it's developed that to become this you know, very diversified data analytics company. Its data helps people, you know, sort of originate loans, decide whether to give people loans or not, prevent fraud, all sorts of things which are more and more important in our kind of data economy. And the information that they have is, a lot of it's proprietary, goes back a long time, that's very valuable, and they've done a great job of commercialising that. So a really interesting kind of long-term success story in the UK. Their results, you know, the Q1 sales were up 5% on an organic underlying basis, which is pretty healthy given what we're seeing in the overall economy at the moment. Yeah,
and more broadly, obviously, there's a lot of optimism following that US inflation data yesterday. Is that misplaced at all, do you feel?
I mean, it's so hard to judge, isn't it? People are constantly watching every single opinion that any member of the Federal Reserve Board is saying about the direction of interest rates. I guess, you know, the core inflation does seem to be ameliorating, you know, up 0.2% month on month versus expectations of 0.3%. And it seems like, especially if you strip out things like shelter costs, so accommodation and rents and things, actually the core numbers are looking a lot healthier. Still not where the Fed wants them to be, but getting closer. So I think the market's starting to think, well, maybe there might be another rate rise, but after that, maybe that's it. I think the bigger question is, when does the Fed start cutting? And that's very hard to tell. And my personal view is it doesn't happen very quickly.
Right. Samji, there's loads more I wanted to ask you. We're out of time, I'm afraid. Thank you.
Thank you.
Still to come here on Business Live, why watchers of Switzerland expect continuing growth despite the somewhat difficult economic outlook. Don't go away.
Fly Emirates. Fly better. Fly Emirates. Fly better. Thank you.
Welcome back. Now, one of the most robust sectors in the global economy since the end of the pandemic has been luxury goods, and that was underlined today by record results from Watches of Switzerland. The UK's biggest luxury watch retailer reported a pre-tax profit of £155 million for the year to the end of April, up 26% on the previous 12 months, with sales rising by 25% to £1.5 billion. We can speak now with the chief executive of Watches of Switzerland, Brian Duffy. Brian, good to see you again this morning. Big increase in sales. How did that? What was the mix there? How much was volume and how much was price?
It was more price or more average selling price than volume, which has been typical for our growth over several years. A mixture of actual price increases implemented by us, but on recommendation by the brands. But the biggest single factor has actually been people trading up on average selling prices, people buying more gold product, less gold and steel, less steel. So the volume contribution actually to that growth is the smallest part. The biggest single part is people trading up an average selling price. And the pricing impact on the whole thing has been somewhere around 7% last year.
And where are prices going over the next 12 months?
In our numbers and our guidance, the impact of pricing is around 3%. We never anticipate pricing. Typically, it happens at the start of the calendar year, happens January, February. We never anticipate it, so we'll see what comes, but there's nothing in our guidance for that. 3% is the carry forward of the pricing that happened last year.
Now, you opened during the year 27 showrooms and boutiques. What's going to be informing the policy on openings this year?
We carry on. We get a great return on capital. You'll have seen our return on capital employed at 27.9%. We get a payback less than 3 years on capital and on working capital. So it's been our entire strategy through this whole period of transformation we've been doing over the last 10 years has been really to invest in big, beautiful stores and client service and marketing. But our return on capital has always been good. We'd spend more if we could. It's a matter of just finding the right opportunities, getting the right level of brand support. But we continually increase our capex, which is driving our sales and profit growth.
And what's interesting is that you're going into a lot of new European markets for the first time.
Yes, we are. We've had a great success in the US. The US is now 42% of our business. We weren't there 5 years ago. All of that has come in the last 5 years. So it's been a great success, actually beyond our expectations, to be honest. And when we decided to go to the US, it was on the basis of us examining the market and seeing that on a per capita basis, it was significantly less than the UK, where obviously we've been present for many, many decades. And we analysed the situation as underdeveloped because of a lack of investment in retail. And I think that's proven to be true with what we and now others have done in the US. So we've done the same analysis in Europe, sales per capita. It leads us to conclude that almost every market in Europe is one in which our proposition would bring success. We started in the Nordics, who were particularly underdeveloped as we've seen. We've just recently opened our first store in Germany. We have a bit of a concentration on Northern Europe, but so far so good. The clients are really responding to the stores, the client service. And we're very positive about the long-term prospects of Europe.
We've only got about 30 seconds left, Brian, but obviously you're about to go into certified pre-owned Rolex in quite a big way. You're not worried that's going to cannibalise the sale of new Rolex watches?
Not at all. There's just not enough, Rolexes in the world. We have long waiting lists and a big disparity between supply and demand. We're adding more names to the waiting list than we're taking off. So the availability of Rolex pre-owned will just be a great thing for our clients who want to get product immediately. It will increase supply, but there's just no way at all that there'd be any cannibalisation on new Rolexes.
All right, Brian, always good to talk to you. Thanks very much indeed for joining me today.
Thank you, Ian.
That's it from me. I'm back at 4:30 this afternoon with our afternoon edition. See you then. Cheerio.